Bitcoin is back near $66,000, and for a lot of people, this looks like the moment the market has been waiting for. After weeks of weakness, ETF fear, macro pressure, and failed rebounds, the chart finally looks alive again. But this is exactly where many traders make the same mistake. They see price moving first, and they assume liquidity has already confirmed. The real question is not whether Bitcoin can touch 66,000. It already has. The real question is whether 66,000 is the beginning of a real breakout, or whether it is the perfect place for the market to trap late buyers before the Fed changes the mood again. This is why today's Bitcoin move is more important than a normal green candle. Bitcoin is not moving in a vacuum anymore. It is moving inside a triangle of pressure: ETF demand, interest rate expectations, and macro liquidity. When all three are aligned, Bitcoin can move violently higher. But when price rises while the other signals are still unstable, the market can create one of the most dangerous setups in crypto: a rally that looks strong enough to attract buyers, but not strong enough to survive the next macro shock. The first thing to understand is that 66,000 is not just a number on the chart. It is a psychological zone. It is close enough to recent breakdown levels to make bulls feel like Bitcoin is recovering, but it is also close enough to overhead resistance to make sellers defend the move. That means this zone is not only about price, it is about confirmation. If Bitcoin breaks above it with strong demand, stable ETF inflows, and a softer macro backdrop, then the market can start believing that the weakness was only a liquidity reset. But if Bitcoin reaches this area while demand is still uncertain, then 66,000 can become a liquidity trap. A liquidity trap does not mean Bitcoin has to crash immediately. It means the market pulls buyers into an obvious level, creates the feeling that the breakout has already started, and then uses that excitement as exit liquidity if the confirmation does not arrive. This is why chasing the first move can be dangerous. The first move gets attention. The second move tells the truth. If Bitcoin pushes into the zone, fails to hold, and ETF flows do not confirm, then the move becomes less about accumulation and more about positioning. That is where late buyers get trapped. The ETF flow is the second gate. Earlier in this cycle, many traders learned to treat ETF demand as the clean, bullish answer. If ETFs are buying, Bitcoin has support. If institutions are accumulating, the downside is protected. But the market is more complicated than that now. ETF flows are not a magic shield. They are a demand signal, and demand signals can change. When flows are strong and consistent, they can absorb selling pressure and support higher prices. But when flows become mixed, weak, or unstable, the market cannot simply rely on the ETF story to carry every rally. This is why a Bitcoin move into 66,000 needs more than excitement. It needs proof that real capital is still willing to buy at higher prices. The third gate is the Fed, and this is the part many crypto traders ignore until it is too late. Bitcoin may be a crypto asset, but it still trades like a liquidity-sensitive asset. When the market believes rates can fall, real yields can ease, and financial conditions can loosen, Bitcoin usually gets more room to breathe. But when the Fed sounds cautious, inflation stays sticky, or yields push higher, risk assets can lose momentum quickly. That does not mean the Fed controls Bitcoin tick by tick. It means the Fed controls the environment where capital decides how much risk it wants to take. And this week matters because the market is not only watching the rate decision, it is watching the message. It is watching the projections. It is watching whether the Fed gives investors permission to believe in easier liquidity, or whether it reminds the market that inflation risk is still not finished. That is the trap. Bitcoin can look strong before the Fed speaks, but if the message pushes yields higher or weakens risk appetite, the same traders who bought the breakout can suddenly become forced sellers. So the clean way to read this market is not Bitcoin is bullish or Bitcoin is bearish. That is too simple. The better question is, what needs to happen for this rally to be real? First, Bitcoin needs to hold the 66,000 area instead of just wicking through it. Second, ETF demand needs to confirm that institutions are not stepping away at the exact moment retail gets excited. Third, the Fed needs to avoid delivering a message that tightens financial conditions. If those three signals align, then the rally has a much stronger foundation. But if one or two of them fail, the market is not giving a clean breakout, it is giving a warning. This is also why the strongest Bitcoin moves often begin when people stop focusing only on the price candle and start watching the liquidity behind it. A green candle can attract attention, but liquidity decides whether that attention turns into a trend. A breakout without liquidity is just a headline. A breakout with ETF demand, macro support, and strong holding behavior is a different story. That is when the market starts shifting from relief rally to real continuation. For now, Bitcoin is in the decision zone. The bulls have a chance, but they do not have full confirmation yet. The chart is giving hope. The ETF data must give support. The Fed must not take liquidity away. Until those pieces line up, 66,000 should not be treated as a victory. It should be treated as a test. And that is the most important point. Bitcoin is not weak simply because it is struggling near resistance, and it is not strong simply because it bounced back to 66,000. This is a confirmation market. The next move will not be decided by emotion alone. It will be decided by whether real capital comes back, whether macro pressure eases, and whether buyers can hold the zone after the excitement fades. So, if Bitcoin breaks higher from here, do not just ask how high the candle went. Ask who bought it, what liquidity supported it, and whether the Fed allowed the move to survive. Because in this market, price gets the click, but liquidity decides the truth.